If you think navies are what close the world's trade routes, 2026 proved something stranger. Insurance companies helped strangle 20% of the world's oil supply without firing a single shot. The route stayed technically open. The ships still stopped. That is how a sea lane can stay open on paper and die in practice. Every container of electronics, every barrel of crude, and every ton of grain depends on that invisible system. And once it failed, the damage moved from tankers to fertilizer, food, inflation, and sovereign debt. That matters because 80% of everything you buy travels by sea. 10 billion tons of cargo move every single year through a handful of narrow waterways most people never think about. The Strait of Hormuz, the Bab el-Mandeb, the Suez Canal, and the Strait of Malacca. These are not just lines on a map. They are pressure points under the whole global economy. Shut down any one of them, and the shock reaches gas stations, grocery shelves, and factory floors almost everywhere. For most of modern history, closing a route like that required obvious military force. Egypt sealed the Suez Canal in 1956, and again in 1967, through traditional warfare, sunken ships, destroyed bridges, and armies dug in along the banks. But that is not how it works now. In the 21st century, a waterway can stay legally open and still become commercially dead. No declaration, no warships blocking the channel, no formal act of war. The closure happens inside spreadsheets and actuarial models, and by the time governments react, the damage is already spreading. The term for this is a de facto closure. So how does a de facto closure actually happen? It starts with one dull-sounding fact that secretly rules global shipping. Every commercial vessel carries a specific portfolio of insurance, and without it, the ship does not move. Hull and machinery coverage protects the ship itself. Protection and indemnity coverage handles third-party liabilities like environmental pollution and crew injury. War risk insurance covers hostile acts. If that insurance disappears, everything else stops in sequence. Port authorities deny entry to uninsured ships. Banks refuse to finance the cargo. Charterers will not load a single container. Those rules are built into the financial architecture of every voyage, and there is no workaround. The vessel stays anchored, the cargo stays undelivered, and the route is closed in practice, even while it remains open on every legal map in the world. This is why a closure can begin in an insurance office, long before it becomes visible at sea. A small group in London effectively controls the risk map for much of the world's ocean. The Joint War Committee, made up of underwriting representatives from Lloyd's of London and the International Underwriting Association, publishes a list of high-risk zones called the listed areas. Once a region lands there, ship owners must notify insurers in advance, or coverage is automatically voided. If they still want to sail, they pay an additional war risk premium to keep the policy alive during transit. During peacetime, that premium barely matters, usually between 0.05 and 0.2% of hull value. In a crisis, it can spike 50 to 60 times in hours. A supertanker, valued at $100 million, can suddenly face a $1 million surcharge for a single crossing at the 1% rate. And if underwriters decide the risk cannot be calculated at all, they pull coverage entirely. That is the insurance blockade, not a military closure, but a financial one. And it works faster than any fleet ever could. Insurance is only the first lock. The second lock lives inside shipping contracts. BIMCO, the Baltic and International Maritime Council, standardized the industry's war clauses, and ConWarTime and VOIWAR went through a major revision in 2025. Those clauses now give owners an explicit right to refuse orders sending a vessel into a conflict zone whenever the master's reasonable judgment says the ship faces war risks. That protection applies even if the danger appeared only after the contract was signed. The third lock is labor. When the International Transport Workers Federation designates a chokepoint as a warlike operations area, seafarers gain the legal right to refuse entry. If they do, the ship owner must repatriate them at the company's expense, with no penalty attached, and cannot punish them for it. When enough crew members use that right, the ship cannot legally or physically sail. So a de facto closure lands on 3 levels at once. Underwriters price the route into oblivion. Contracts give owners the legal cover to walk away, and labor law lets sailors refuse. Governments can insist the lane is open. Navies can patrol it. Shipping still stops. That entire system became visible in the 2026 Strait of Hormuz crisis. Hormuz connects the Persian Gulf to the Gulf of Oman and the Arabian Sea, and before 2026 it carried roughly 21 million barrels of petroleum liquids every day, representing over 20% of global petroleum consumption. Qatar's liquefied natural gas exports depended on the same passage, with about 82 massive commercial vessels making the crossing daily. At its narrowest, the strait is roughly 21 nautical miles wide between Iran and Oman. But the deep-water shipping lanes supertankers actually use fit into two corridors only 2 nautical miles wide each, separated by a 2-mile buffer zone. In practice, the commercially usable channel is only 4 miles across, which means the system does not need a total physical seal to fail. On February 28, 2026, the United States launched Operation Epic Fury alongside Israeli forces against Iran. Over 3,000 targets were hit in the first week, including military command centers, nuclear sites, industrial zones, and major cities. Iran's supreme leader and 48 senior officials died in the opening salvo. In the Indian Ocean, a U.S. submarine torpedoed the Iranian frigate Iris Dina, the first combat sinking of a warship by an American torpedo since 1945. Iran did not answer with a conventional naval defense. Outmatched in traditional terms, the Islamic Revolutionary Guard Corps chose an asymmetric strategy, designed to weaponize the strait's financial architecture rather than physically block it. IRGC operators broadcast VHF warnings, declaring any commercial vessel heading for the United States, Israel, or their regional partners a legitimate military target. Within days, drone boats, limpet mines, and anti-ship missiles struck at least 21 commercial vessels in and around the strait. The goal was not to sink enough ships to plug the channel. The goal was to break the insurance market, and the market broke fast. On March 3rd, the Joint War Committee released Circular JWLA 033, expanding the risk map to cover the entire Persian Gulf, the Gulf of Oman, the Indian Ocean, the Gulf of Aden, and the southern Red Sea. Premiums that had been 0.05 to 0.2% of hull value jumped to 0.85%. Then 1%, and for certain flag states, as high as 5 to 10%. Rafael Fernandez, senior vice chair of the IBA Insurance Committee, said the private market was being pushed to a breaking point. At the same time, GPS interference reported by the UK MTO and the Joint Maritime Information Center produced positional offsets, AIS anomalies, and degraded navigational accuracy, turning those 2-mile-wide channels into collision traps. One by one, the largest carriers stepped away. Maersk, MSC, CMACGM, Hapag-Lloyd, and COSCO all canceled bookings through the region. Traffic collapsed by 95%. Tracking data showed total transits dropping from 50 on February 28th to absolute 0 on the eastern and western approaches by March 3rd and March 4th. More than 150 oil tankers and 170 container vessels sat anchored off the Gulf of Oman, with nowhere to go. Washington tried to force the market back open. The U.S. Development Finance Corporation rolled out a $20 billion insurance facility to replace private coverage. The industry treated it as political theater, not a real solution. The DFC had no claims processing infrastructure comparable to Lloyd's. Its $20 billion cap was too small for the volume that needed to move, and it excluded environmental liability and pollution coverage. Without protection and indemnity backing for the risk of a catastrophic oil spill, no shipowner with a functioning legal department was going to authorize transit. The failed DFC experiment made the bigger point clear. Ad hoc government insurance cannot simply overrule the discipline of commercial underwriting. Then the commodity shock hit. Storage facilities in Kuwait, Qatar, and the UAE filled to capacity almost immediately, forcing Iraq, Kuwait, Qatar, and Bahrain to slash oil production. On March 7th, the Kuwait Petroleum Corporation declared force majeure. Qatar's Ras Laffan, the largest LNG facility on Earth, stopped completely. Brent crude climbed from roughly $80 a barrel to $126 in 3 weeks, a 50% surge. European TTF gas jumped 59% and moved past €60 per megawatt hour. half of the world's seaborne sulfur trade froze in place, and a third of all globally shipped fertilizer sat stranded. Fertilizer prices rocketed 165% year over year. The UN Food and Agriculture Organization warned of a double shock hitting farmers with fuel and fertilizer inflation at the same time. Asian equity markets fell an average of 5% as stagflation fears spread. Hormuz was extreme, but the blueprint had already been tested in the Red Sea. Under normal conditions, the Bab el-Mandeb carries 7% of global maritime trade, roughly $700 billion a year, including 50 million tons of agricultural products and about 4.1 million barrels of oil per day. Starting in late 2023, Houthi militants used anti-ship ballistic missiles and drones against commercial vessels, and tied those attacks to political demands connected to the Gaza conflict. Once again, the insurance market moved before politics could catch up. The Joint War Committee listed the region. Premiums that had sat at 0.05% and were often waived altogether moved past 1%. Maersk, Hapag-Lloyd, and CMA-CGM abandoned the Suez Canal and rerouted around the Cape of Good Hope. By the end of 2024, vessel traffic through the Suez Canal and Bab el-Mandeb had fallen by 75%. Those diversions added 3,500 to 6,000 nautical miles and 10 to 20 days to a voyage. The cost of taking the long way around was brutal. Crude oil shipping costs rose by $2 to $4 per barrel. Carbon emissions from the detours climbed 40% over direct Suez passage. Container rates on the Asia-North Europe lane jumped from around $2,300 per 40-foot unit to over $6,000. Asia-Mediterranean rates went from $1,800 to $5,200. Air freight climbed 20% as shippers scrambled for alternatives. Even when the shooting slowed, the closure effect lingered. Operation Prosperity Guardian, a U.S.-led naval coalition, intercepted dozens of incoming projectiles. Yet Suez Canal traffic still remains 60% below pre-crisis levels for extended periods. Carriers and insurers do not snap back after a few quiet days. They want sustained, verified evidence of safe passage over weeks or months before restoring coverage. A de facto closure embeds itself in the commercial mindset, long after the shooters stop shooting. That is why it keeps working long after the first attack, and long after the television headlines move on. Now follow that logic into food. Global urea exports and 50% of global sulfur exports pass through the Strait of Hormuz. Natural gas moves through the same waterway, and that matters because gas is both the energy source and the chemical feedstock for producing nitrogen fertilizer through the Haber-Bosch process. Shut down the strait, and you create a dual supply shock at once. Finished fertilizer is trapped, and the raw material needed to make more gets more expensive everywhere. That is exactly what happened. Gas prices climbed high enough to force European and Asian fertilizer plants offline. Middle East urea prices jumped 19% and crossed $590 per metric ton. Saudi producers raised benchmark urea from $402 to $450 per ton. By the end of March 2026, the global benchmark for dry urea had climbed from $560 to $770 per ton, a 40% increase in under 2 months. Brazil and the United States were both badly exposed, just in different ways. Brazil imports 8 million tons of urea each year, plus 96% of its potash and 95% of its nitrogen fertilizer, much of it from the Gulf. For American row crop farmers, fertilizer already represents 33 to 45% of total operating expenses, while the country imports roughly 18% of its nitrogen fertilizer and 95% of its potash. The disruption was serious enough that Washington suspended the Jones Act for 60 days, so emergency domestic fertilizer shipments could move on foreign-flagged vessels. Timing made everything worse, because the crisis hit right in the Northern Hemisphere's spring planting season. Fertilizer has to be applied inside a narrow seasonal window to work. If farmers cannot get affordable nitrogen in March or April, the choice is brutal but simple. Spread less fertilizer or leave acreage unplanted. Either option guarantees proportionally lower crop yields in the harvest that follows 6 months later. A shipping disruption that lasts weeks in spring can become a global grain shortage by September. Freight shocks that spike and never fully recede embed themselves permanently in the price of everything. OECD research shows that a 50% annual increase in global shipping rates lifts consumer price inflation in OECD countries by about 0.25 percentage points. A 15% increase in shipping costs adds around 10 basis points to U.S. core inflation in the first year. During the combined Red Sea and Hormuz crises, spot freight rates in key corridors surged over 400%, and the OECD estimated the resulting pressure lifted merchandise import prices across member countries by 2.5 percentage points on average. What makes this kind of inflation especially damaging is how slowly it fades. Shipping costs hit imported goods first, then spread into labor costs and service prices. Euro area core inflation stayed at 2.4% in 2025 and 2.2% in 2026 because services inflation did not come down as fast as goods inflation. Central banks kept interest rates higher for longer, which raised borrowing costs, slowed investment in emerging markets, and added debt servicing stress to governments already under strain. A missile in a choke point can echo all the way into credit markets. Egypt shows what that looks like when the pressure becomes sovereign. Transit receipts by 24.3% to approximately $6.6 billion in the 2023 to 2024 fiscal year. By 2024 to 2025, the trade deficit had widened 28.9% to $51 billion. The Egyptian pound moved from 30.89 per dollar in June 2023 to 49.59 by June 2025. Net external liabilities reached $293.6 billion. What began as a militia-driven shipping crisis ended as a full IMF intervention problem and a sovereign liquidity crisis. Seen across time, the pattern is unmistakable. Warships arranged in a line to physically seal a waterway is becoming functionally obsolete. During the 1980s tanker war, over 400 civilian merchant ships were damaged, and more than 400 seafarers died. Yet Hormuz never fully closed because the weapons of that era could not break the insurance market's tolerance. By 2023, Houthi militants using cheap drones and ballistic missiles achieved a 75% traffic reduction in the Red Sea corridor. By 2026, Iran pushed the Strait of Hormuz to a 95% standstill in under a week. Each generation requires less military capability and produces greater economic damage. That is why the deadliest weapon in modern maritime warfare is not the missile that hits the hull. It is the unquantifiable risk that missile injects into insurance policies, charter party contracts, trade finance instruments, and corporate risk models. A formal blockade presents a traditional military problem with a traditional military answer. A de facto closure is an economic contagion that embeds itself in retail prices, starves factories of components, drives persistent inflation, and works like a regressive tax on the global economy, falling hardest on the countries least able to absorb it. And until governments build permanent, pre-funded insurance backstops capable of replacing private coverage overnight, reduce their dependence on single choke points, and accept that frictionless, low-cost maritime transport may not fully return, the world's trade routes will remain hostage to the quiet arithmetic of economic closure.